Welcome to Talker Tickers. Today, we're digging into Kroger's latest earnings report. Now, on the surface, they beat expectations and even raised their forecast for the rest of the year. But the stock, it pretty much went nowhere. We're going to find out why. So Kroger served up what looks like a classic beat and raise quarter. That's the kind of report that usually gets investors pretty excited. But this time, the market just shrugged. The big question we're tackling today is, what's the deal with that disconnect? All right, first things first. Before we get into the why, let's ground ourselves in the what. Let's take a look at the headline results and see exactly what Kroger reported. So the story here is a little mixed, but it's definitely mostly positive. You can see that revenue, the top line, was a slight miss against what analysts were looking for, but the bottom line, that's the adjusted earnings per share, came in well ahead. And really importantly, identical sales, which is a key metric for how the stores themselves are doing, showed some really healthy growth. Yeah, that EPS number, $1.04, that represents a solid beat of about 5 to 6% over what the Wall Street consensus was. So from a pure profitability standpoint, there's really no question about it. Kroger absolutely delivered. But the real engine of the quarter was right here. Identical sales, that's how you measure performance at stores that have been open for at least a year, grew a really strong 3.4%. And just look at that e-commerce number, up 16% year over year. This digital acceleration is just critical to their long-term story. And here we have it, the central puzzle. After a clean earnings beat with strong underlying growth, the stock finished the day basically flat. Now, this tells us one of two things. Either the market completely expected these good results, or it's worried about something else just over the horizon. So, how did Kroger pull it off? It's a great question. Let's look at the actual strategy behind these strong sales numbers. Management's success this quarter was definitely not an accident. It was built on 3 core pillars. First, they've been really aggressive with what they call price investments. Basically, cutting prices on thousands of items to get people in the door. Second, their omni-channel moat, which is that blend of physical stores and digital, is just getting deeper. And third, they're showing some really impressive margin discipline, which was helped by them pruning some of the underperforming parts of the business. And this quote from the CEO, Ron Sargent, on the earnings call, it just gets right to the heart of their whole strategy. Unlike some of the pure-play e-commerce companies, Kroger is using its thousands of stores as mini fulfillment centers. And that, right there, is their biggest competitive advantage in the whole race for cheap, fast grocery delivery. So where did that 3.4% identical sales growth actually come from? Well, what's important here is the really healthy mix. You've got strength in higher margin areas like pharmacy and fresh, and you combine that with the continued surge in e-commerce and their own private label brands. That creates a pretty powerful tailwind. Okay, so that was the quarter that was. But Wall Street, it's always looking forward. It's always about what's next. So let's look at what management's guidance and strategic plans are telling us about the future. Now, this is fascinating because it really shows a company pivoting from playing defense to going on offense. In 2025, the whole narrative was about closing unprofitable stores and, streamlining. But looking ahead to 2026, they're planning to actually accelerate new store openings by 30%. That is a crystal clear signal of confidence. And that confidence, it's backed up by hard numbers. Management raised the full-year outlook across the board. They lifted the low end of their guidance for identical sales, for adjusted earnings per share, and for operating profit. This is the raise in that whole beat and raise story. So we've reviewed the numbers, the strategy, and the outlook. I think it's time to put it all together and issue our rating. Let's make the call. After a solid quarter that the market met with a bit of a yawn, the key question really remains, where does the stock go from here? Our rating on Kroger shares is market perform. And here's the thinking behind that. The pros are obvious, right? Management is executing beautifully, guidance is up, and their digital business is accelerating. But the cons are just as important. That quiet market reaction tells us this solid performance was already priced into the stock. Competition remains absolutely fierce, and as management themselves pointed out, the comparisons get much tougher in the second half of the year because they'll be measured against last year's really strong performance. So, in short, while Kroger is doing a lot of things right, the bar for success is already set pretty high. All right, for our final segment, let's put on our analyst hat for a second and explore a potential trade idea. And while this slide gives you the disclaimer right up front, let's just unpack the logic behind a more advanced strategy. Okay, so here's a plausible trade idea. It's what's known as a pair trade, and it's basically a bet on one stock to do better than its overall sector. The idea is to bet on Kroger while at the same time betting against the broader consumer staples sector. This way, you're not just betting on the whole market going up, but you're betting specifically on Kroger's ability to outperform its peers. The bet is that its strong execution will make it a winner, even if the rest of the sector kind of lags. And a potential catalyst here could be something like rising tariff concerns, which often cause investors to look for solid, domestic companies, just like Kroger. And as always, a final reminder for everyone, this is not financial advice.